So we're describing this as a hawkish cut. What do you make of the language that's coming from the press, or do you agree with that description?
Yeah, I mean, it's a little bit less dovish than I think people would have expected, but I don't think investors need to overreact to it. I mean, it's a Fed that is now, it's most importantly backed away from the tightening stance of last year. It has put a couple of rate cuts in place and continues to signal that they will respond if necessary to continue to extend this cycle. So yeah, it's a little bit less dovish than expected, but I don't think that is huge implications for the markets.
So, Brian, the response, we've got equities that are coming off a little bit, and then bonds coming off a little bit, and then it seemed like he introduced some language here in the presser that talks about maybe balance sheet expansion on the back of the whole repo thing yesterday. I know everybody was looking for anything that sounds anything remotely like QE, so what do you think this sounds like?
So again, I think it's, obviously the bond market's telling us that it wasn't enough from the Fed. The bond market usually gets it right more often and is saying that this is not as growth positive as they would have expected. I think the Fed is trying to go at this at a gradual pace. They're putting, a rate cut out there and then trying to see how the markets respond to that to at least give themselves some type of flexibility down the road. But again, bond market gets it right more often than anything else. So the bond market's saying right now it's not enough to support growth. I suspect that you will see further expansion of the balance sheet and you will see the Fed cut rates in the future. Again, this is all about taking back the rate hikes of last year, which at the time I thought were inappropriate. So,
Brian, to come back to the bond market real quickly, though, because we're up on the day since we started trading futures, but since the announcement came out, we're actually down in bonds. I would think that if you believe the bond market at face value in yield curve inversion, if he came up short, then I would think the bonds would be rallying instead of selling off after the announcement.
Yeah, I mean, so it's not short in that, this is imminent recession and this is, big flight to quality and bond yields in significantly, but the shape of the curve matters, and the shape of the curve is telling us that we still need some impulses for growth on the long end, and perhaps some clarity on trade will get us there, and the Federal Reserve is going to have to be ready to ease further if we continue to persist in a time of trade uncertainty that weighs on sentiment, that weighs on manufacturing.
Okay, so we look at the dot plot and it's signaling maybe we get one more basically, but not even everybody's on board for that. The Fed funds futures suggested they wanted more than that. So if there's not this big kind of rush to safety, as we're seeing, Brian, with the flattening yield curve to, kind of based on which range you pick, but still that 10-year coming off a little bit. Is it possible that we saw that bottom in the 10-year yield? Is it possible that the bond market has changed direction over the past week and a half?
Oh, yeah. I mean, 150 on the 10-year was a pretty ominous sign, much the same way 325 on the 10-year a year ago was an interesting sign, and neither one appeared to me to be sustainable. 325 was the bond market believing that growth was going to be stronger than it really could have been. 150 was the bond market saying that if we don't see some better policy mix here, we're heading into a recession. I believe the answer is somewhere in the middle, and for in a country that's going to grow at roughly 2% in real terms, 10-year rate should probably be closer to 2 rather than 150. 3% didn't make a lot of sense. 150 doesn't make a lot of sense. The answer's in the middle.
Brian, how important is it then to watch to see if that was indeed the bottom of the 10-year yield, the trajectory and the speed at which it sells off? Because, I mean, I'm old enough to remember, a couple months back when yield curve inversion basically meant recession was a sure thing. It was the end of the world, and the debate in stocks was how many pennies can you pick up, before the tractor gets you. Now it's like maybe we shouldn't have believed the inverted yield curve. So, where does this story go next? Because about a month ago, there was no bigger consensus I think I've ever heard, Brian, than that yields are only going to go down. Negative yielding assets will only go up. Or should we be questioning that consensus?
Yeah, and at the time what I was saying was we have to be cognizant of what the yield curve is telling us, but it's not as if we need to accept an inverted yield curve. So the inverted yield curve was the result, not traditionally it's the Fed raising interest rates above the 10-year. This time it was the 10-year coming down to short rates, and that was the result of uncertainty around trade. And so what you've seen since that point has been an additional Fed rate cut, and you've seen the administration say that at least we're going to have some plan to meet with China in the future, which helps to pick up sentiment a bit. So yeah, it sends a signal, but you need to persist at an inverted yield curve for some time before a recession looms. In my opinion, the backdrop remains the same. It's a slow growth environment in the United States, which means inflation is relatively benign, which keeps policy generally accommodative. That's a good backdrop for risk assets. That's a good backdrop particularly for growth stocks. The way it ends is with a policy mistake. So could you get there if the Fed makes a mistake here? Yes, but I think that's increasingly off the table. Could you get there if the uncertainty around trade persists? Yeah, that could potentially invert the yield curve and lead us into a recession. I suspect the administration is going to attempt to provide more clarity on that, help to bolster business sentiment in what's going to be an election year.
Brian, if that happens and we get trade resolution that clears away so much of the sort of concern, I think that also was a big part of why the bond market sold since Thursday of now 2 weeks ago, almost 2 weeks ago now. So the last point here is we put all this together, and with the market's response, the data that we've gotten recently, what sort of presents a bigger risk to kind of the status quo? Is it really recessionary, possibility here in the U.S., or is it that people who were betting basically and preparing for such a recession now have to change their sort of positioning if the bond market is indeed turning around?
Yeah, I mean, I don't think we're heading into a recession anytime soon. I hope that investors, if they had long-term plans built out, weren't trying to time the recent moves in the bond market or the shape of the yield curve. By the flow data, you could certainly see that some people were.
Right.
It really depends on your time horizon, but if you're looking for long-term growth in your portfolio, I still believe we're in a secular bull market. That secular bull market will likely end after a series of Fed rate hikes, not cuts, and valuations higher than they are today.
For those that have been buying all the momentum, all the low rate plays that have been a big part of this market rally, we saw them come under pressure with last week's bond sell-off. Do you have to be worried about those if, again, continuing if there is bond direction with yields to the upside?
Yeah, I mean, some of the bond proxies won't do as well on a cyclical basis, but we need to be careful of our time horizons because a steepening of the yield curve or 10-year rates going higher is going to hurt some of those bond proxies in the near term. But I'm not saying interest rates are going to go meaningfully higher. I'm saying interest rates are going to align themselves with where real economic activity is going to be. So in the near term, some of those bond proxies might get hurt. I think investors will be fine there over the intermediate term. I still think that what's going to outperform are going to be true growth assets in what is a slow growth world. So I don't believe in this pivot to the more value-oriented parts of the market. That does work with, a bit of a shift in yields higher, but is unlikely to be sustained.